Well, welcome to this week's Cattle Call. We took a week off because of the NCBA meeting that took place last week. Having said that, we are looking at some maybe shorter cattle and some higher prices. Two things that might make it decent for that cattleman. We're going to get all the details today. As you can see, Brad Kooima is on the screen. He's with Kooima and Varlick out of Sioux Center, Iowa. So let's first of all talk about these cattle numbers. How high? I mean, we had decent numbers on a Wednesday. How high could we see this go?
We're going. What's that line out of Back to the Future? Where we're going, we don't need roads, right?
Yep.
At some point, the culmination of liquidating the cow herd for 3 years, and then the ironic twist where now we're going to decide to increase our kill capacity here in another year and a half or 2 years when those things come online, I would think you're setting up for quite a thunderclap of consequences. So, it's always fun to, I can be a smart aleck like the best of them, right? Where are we going? At some point, I think the market's going to a place where it has not been before. And of course, the all-time high is in that 175 area. Now, is that tomorrow? Of course not. If you look backwards, like we've talked before, I'm a kind of an old school fundamental guy a little bit. 2011 was the highest cow slaughter that we'd had in the last 20 years. The second highest was last year. So we're killing a significant amount of females. That's the third year in a row where we've killed a lot of them. So, but don't forget, 11 and 12 were the big cow slaughter years, and it took until 14 for that, to catch up. Yeah, that's the cattle cycle, right? You decide, okay, now it's the key to this thing is it going to rain this spring or not? Are we going to be able to replenish these pastures so that the rancher decides to, what, I'm not going to sell every heifer. I'm going to try to save some. I'm going to try to rebuild the cows that I had to sell for either cash flow or because I just flat ran out of grass because of the drought. And that's going to be the catalyst that really, starts the thing going. But it's fun to have cattle that are making a little money right now. And it's fun to think ahead about the way things maybe could get to. So I don't want to get ahead of myself, but I think I should let you ask a question, shouldn't I? What I'm hearing though, what I'm hearing the last little while, I thought this was interesting. I want to make sure I don't forget to mention it. I had somebody tell me today who's been at this a long time, almost as long as me. And he said, it feels like it did in August of 2019 before the fire. So he's a commercial, right? I mean, he's in the business of buying and selling meat. And I thought to myself, so finally, after all of the stuff, right? I mean, in other words, what he's trying to tell me is that, by the employees are coming to work, we can expect that they'll be here and then they're here. We can expect that we can get transportation to get our product out. We can expect normal course of business in terms of demand. People are going to the restaurant. We can sell hamburgers, $5-6 a pound. People, I mean, you're instead of like all this other stuff, the background noise that was like limiting the market from functioning like it ought to properly. Maybe, well, I hate to say it and jinx it, but maybe we're getting this thing finally back to what it used to be like before COVID, right? And before the Holcomb fire.
So I call you a mind reader because I was going to ask you about all this pre-COVID, pre-Holcomb fire, but then you brought up 2012. And from a grain perspective, that's been talked about a lot. From a cattle perspective, we don't have the feed stuff because the pastures are too dry. And you're talking about increasing and heifers coming to market. Does that not bode well for the future of this cattle market on the near term?
Yeah, it does. And you can't hardly bring up 2012, of course, without most of us cattle feeders getting a muscle cramp, right? I mean, even if cattle are $1.50 and corn's $9, things aren't going to be so hot for us, right? So not, of course, being able to predict what kind of growing conditions we're going to have. I just think this is going to be, and I think that's why the market is so volatile. You bring up the corn, got a bearish report today and was up 14 cents anyway. It's like, wow, who cares, right? If that right set of events happen though, that if we do start to get rain and we hold off these heifers, if you get a place where the producer is confident that, okay, corn's going to be whatever, 550 instead of 750, It's going to start over in the feeder cattle. These guys are going to come plowing after them like you've never seen before. And of course, look at the back end of the cattle already. August feeder cattle at 186. I mean, we're up there in the rafters already. And I think for the very reasons that you and I have talked about here the last 5 minutes. And that's, I'm not the only one that can keep track of how many cows got killed, right? So we're going to have less supply. Hopefully this is the year where we turn the crank and we can able to start to rebuild the herds. That's the phase of the market. Of course, that's the most bullish when those heifers stay out in the grass instead of in a feed yard somewhere.
So as we wrap this up, what about the meat counter movement? Consumers are getting those bills from Christmas coming in the mail and all the other things that are happening and trying to pay stuff off. They look at those prices. Are you starting to see or hear any pullback?
That is a fantastic question. And I'm going to say that certainly was the vibe. So yes, short answer. It got squirrely though, because in January, when you would have expected the largest impact of that deal, that's when we had all these absenteeism. I mean, we had this whole burst again of COVID and flu, where you had this sharply reduced slaughter. So I think we'd have really found out the reality of where at what price will this stuff move until we shortened up the supply again because we weren't able to get enough slaughter going. So you're probably getting a secondary impact now, Susan, where typically you get 10 days before the Super Bowl, you'd expect demand to slow way down. That's just an old seasonal, right? So I mean, we're right in that window. Now a lot of places didn't have winter. I mean, it was 60 degrees here yesterday.
Yep.
The crowd is starting to think a little bit ahead of just how good is this demand going to be once we get back to grilling season. I think it's a little early. I think that anybody would tell you today that there's some meat setting around. That some of these guys that are still trying to catch this high price on some of the middle meats, the ribeyes, strips, and stuff like that are paying for it by having to reduce and get discounted. I don't really look for that to catch until sometime late March. So I think there's a lull here where the beef indeed is going to suffer just a little bit. But the Packers got such a margin here that don't worry about him. He'll be just fine.
All right. Well, thanks for joining us this week.
Of course.
And as always, folks, just a reminder, commodity futures and options do involve a substantial risk of loss, not suitable for all investors. And that has been the Cattle Call. I'm Susan Littlefield here on the Rural Radio Network.